What's going on, everybody? We're going to talk about the Chris Lapointe CFO Fireside Conference at the UBS Tech and AI Innovation Conference, something like that. Basically, SoFi's Chief Financial Officer is going to, in 10 minutes, go live, and he's going to be talking, about SoFi. Generally, these moments in the past, we've covered them. They really give us some pretty key pieces of information, nuggets here and there. And so in this video, we're going to be listening live together, and then we're going to be trying to piece what they're saying. Currently, SoFi stock is slightly down. It's down about 0.5%. It was down more actually earlier in the day. It recovered. I think it turned green at some point today, and it's basically flat. But SoFi's been on an absolute run, right? Like, we know that this company has been over 50%, like over the past couple of months, or over the past month, I should say. I think it's 100% over the past couple of months, at least since the last quarter earnings results. And so we're going to see here what Chris Lapointe is going to say. Again, there's a lot of stuff that we're looking for in this fireside, particularly. I remember last year in the December fireside is when he dropped that top five bank, essentially, that was working with Galileo, or was at least in a POC with Galileo. So we're going to see what he drops this time around. I see people just rolling in. HIMS Weekly is going to be tomorrow instead of today. It's actually going to be a little bit earlier in the day during trading hours tomorrow. So stay tuned for that. I'm going to be scheduling that probably a little bit later today. The rest of the crew is all in New York, because normally I'd be doing these with Tanner or with Roy or somebody else, because I don't love doing solo live streams. But everybody is in New York right now for the Robinhood Investor Conference. So I just thought I would jump on and cover this event myself. Do we really think we hit 25 by next year if he says top five bank again? Well, so here's the thing, right? We need confirmation from the management team in the form of an earnings report or a Q&A on earnings. A lot of these banks have NDAs, so they won't really be talking about dropping logos, but we will basically see that confirmation if we see spikes up in accounts. Accounts right now have been the slowest growing thing. Over the past little while, it's actually their slowest growing segment. So it really is a matter of deduction for us to see the accounts and how those are going up over time. And I think that, I've said this in the past, where that narrative around the AWS of finance has been somewhat replaced now with the loan platform business. That's what investors and Wall Street in general is turning their eyes towards for where SoFi's growth is going to come from. And that AWS of finance aspect has been pushed further back into the future because of the growth rate that has been diminishing somewhat. SoFi stock is just getting a little bounce. It's about flat right now. New is killing me. Yeah, so Nubank, I was looking into this one to potentially start a position, my first position in Nubank. I haven't done so yet because the premiums are not great, but I might be considering it if we get this continued weakness in Nubank. I might just start a position with probably proceeds that I get from flipping the miners. CleanSpark was down like 12% today. It's only down 4% as of this recording. So we'll see how that goes with regards to the miners. I saw Marathon did more convertible notes. But essentially, yeah, I want to be flipping the miners their short-term trade, and I'll probably put some of that money into Nubank. So with that said, I do have the Fireside web conference on my other screen. I'm just waiting. It's just music right now. They haven't started, but we'll see what they say, honestly. This is our first chance to hear from SoFi management really since the earnings call. We haven't really heard anything. I did see, however, that, and maybe I can throw this up on the screen, but SoFi lowered their APY on savings accounts from 4.2% to 4%. Let me throw this up so you can just take a look here. So here you have some of the comparables with regards to their saving and their checking APY. SoFi is still among the leaders in terms of the APY that they offer, although they did lower that down, which is something that goes against what we were talking about. We were talking about this higher for longer narrative with regards to APYs and how that was going to potentially be a further catalyst to have people on SoFi because they are so vertically integrated. And through Galileo and through the fact that they now have a bank charter, they can afford to keep the savings APY higher for longer to essentially, give some more benefits to their user base relative to especially the legacy players, but even some of the newer players that have to have a partner bank that eats into their margins. And what we're seeing right now is basically SoFi is front running the rate cuts by lowering this savings APY. And management did comment on this on the earnings call. They basically said, hey, look, there's a supply and demand sort of equilibrium. And if they're seeing a ton of demand, they want to be experimenting with lowering that APY because it's essentially more profitable for them to do so. And the only reason that they wouldn't lower that APY is for them to spur more demand. And so if they're lowering the APY, to me, it says that, well, this is a lever that they can pull. It's in their hands to keep it high or to lower it. And the fact that they're doing it means that demand is strong enough. That's the rosy colored glasses narrative. So we'll see what management says, but essentially, they've lowered it. They still have one of the highest out there, and they're probably doing it to front run the rate cuts that we're expected to get. Okay, let's see here. Did you hear that Canada will be part of the US soon? Yes, I heard that, and I commented on that on X. I said, hey, look, if it ever comes into like a Brexit type of referendum where citizens are asked to vote, you all know how I will vote for that. Look on Fintel, institutional ownership increasing. So you're going to get this, right? You're going to get more institutions piling into SoFi because it has an added layer of legitimacy that comes as a result of them having 4 quarters of GAAP profitability, as a result of them having these pretty aggressive growth rates. I think the loan platform business really changed the narrative to the upside because all of a sudden now you have some serious additions to EPS that's not just exclusive to their initial partners that they're going with. They can actually do this more frequently, and that can compound pretty effectively. Tanner is also live. Is he actually from New York? That's funny. I should have messaged him. Now I feel bad. Okay. But I'm more fun. So y'all are here instead. With Tanner, you'd be getting some lame chart. I saw this. Palantir is exploding. It's like $71, which is kind of crazy. I'll talk to Roy about that. We'll have a bootleg weekly once he comes back from the Robinhood Investor Conference. Yes, Jesse, you have the right idea here. So let's take a look now. This Fireside is supposed to start in a few minutes. And we still have intro music. So yeah, way better hair over here. Actually, speaking of better hair, Hims is up 5% today. So congratulations to all of you that are in Hims. It was up as high as almost double digits. And then it fell back down to like flat-ish. And now it's back up to 5%. It's at 32.5 as of this recording. I am not buying Palantir. It's actually funny because I had a good friend of mine say he wants to short Palantir at these prices. And he was like, hey, you should do the same. And I told him, hey, look, with a company like Palantir, with an investor base like Palantir's, it can be at 60, it can be at 70, it can be at $80. And I'm like super neutral. I won't touch it with a 10-foot pole either way, whether that's buy side or short side. So I'm not going to be doing that. I am more than happy in the positions that I'm in, with SoFi's stock performance recently, with Hims performance recently, with Tesla and Bitcoin as well. I'm doing very fine, and I wish them all the absolute best. So thank you to 185 of you for being here. We're going to get this started in just a moment. The Fireside should be starting in the next couple of minutes. I will throw that up on the screen once it does start, and then we can all listen in together. Yeah, exactly. Your friend is looking to get run over by that freight train. Exactly. it's you can I think I mean, look, I sold the thing way too early. I would have had a 10x by now, and yeah, whatever. Like I learned my lesson there. I think Chris Patel was the one, or somebody in the community went short at like $30, and that community has shown that they won that battle. So at some point or another, it's going to pull back. Probably the first time they report an earnings growth rate that's slightly lower than expected, because it can't keep accelerating forever. And at that point, it's going to get hit disproportionately. And I believe the same thing with Nvidia and with a lot of these others who have essentially front run a lot of their growth. Luckily, with SoFi, right, like we're seeing the stock growth come following the great momentum that we've had, fundamentally speaking, because we've been executing on a fundamental basis for several years and we haven't had that stock performance. And so now it's essentially getting to that level where it's, fairly valued, right? It's not necessarily overvalued, even though it's done a double up, right? So the fundamentals, I think, are the real component, because, I mean, in the case of Palantir, just because, we're talking about it, the growth rate is the same. They're both at like 30% ish. And yet, one has done a 6 or 7x and one has done a 2x. Thank you. Thank you, Christian. Yeah, I think we're in different weight divisions, my man. Tanner has been working out recently, so maybe that would be actually fun. I thought they had YouTubers that did like a boxing thing at some point or another. That would be fun. I don't know if Tanner would be down for that though, but we'll see. Yes, gingerly touch the like button. Tanner does not respond to me, so here I am. Yeah, my social awkwardness comes in handy when I'm in front of a camera, in front of 200 people. I will bring up the chats just to um, pass the time until this actual conference starts. We still have elevator music, so just give it another minute. I brought marshmallows. Okay, guys, you can't make me laugh throughout this entire fireside. I have my iPad out. I'm going to try to take some notes and try to actually, do a good job of summarizing the main pieces here. I can't do that if you guys are just going to make me crack up all throughout the fireside. So you just keep it in mind. Let me just refresh this actually. Hopefully, I don't lose my spot in queue. Yeah, it's still elevator music that I'm seeing here. Oh, nope, still music. So it should be starting very shortly. And here we are. So let me know if you guys can hear this.
Okay, great. Welcome everyone to the
Yes.
UBS Global Technology and AI Conference. We're very happy today to have with us the team from SoFi. Up on stage with us today is Chris Lapointe. Chris is the CFO of SoFi. Really appreciate you making the trip, Chris.
Awesome. Thanks for having me, Tim.
All right, we've got a great lineup of topics that we're going to attempt to cover in the 30 minutes that we have here. We're going to start with talking a little bit about loan origination trends. Then we're going to get into some more kind of Q4 quarter to date and more looking into the near term revenue outlook. Then we'll break it into some of the three sub-segments. We'll talk a little bit about lending, we'll hit financial services, we'll hit the tech platform and Galileo, and then we'll wrap up with some more sort of financial results type of questions if we have time. So with that, Chris, why don't we kick things off and talk around loan origination volumes that were pretty strong in Q3, both on the student loan side and the home loan side. Over to you.
Yeah, absolutely. So what I would say is we've had really good momentum in terms of originations throughout 2024 year to date. But as a reminder, our overall outlook on the pace of growth of our balance sheet has remained unchanged at seeing modest growth in nominal dollar terms for the year. We've been able to maintain that outlook and still deliver really good returns across all three of our asset classes that we originate. We've been able to achieve record revenue in several quarters. We've also been able to achieve 20 to 30% annual revenue growth over the course of the year. In terms of how we think about the pace of originations in any given period, it's a function of a number of things. First, it's a function of the demand that we have from a credit buyer perspective. It's a function of where rates are, where credit spreads are, where losses are trending. And what I would say is throughout the course of 2024 and the last 12 months specifically, we've seen really, really good demand from a capital markets and credit buyer perspective, probably the best that we've seen over the course of the last several years. Over the last 12 months, we've sold over $6 billion in loans across all three of our products. And that doesn't include the $1 billion of originations that we did on behalf of others as we expanded our loan platform business this past quarter in Q3. In addition to that, we're seeing a really good trajectory in our overall delinquencies and losses. And that coupled with robust capital ratios at north of 16% relative to a regulatory minimum of 10.5% has enabled us to scale originations at the pace that we have throughout the year. So in Q3, we ended up doing record originations at $6.3 billion. We had record personal loan originations at $4.9 billion. We had our best quarter in student loans since Q1 of 2022, and we had our best quarter in mortgages since 2021. So overall, really good momentum while sticking to our overall outlook for the balance sheet size.
Thank you, Chris. That's a great update on the loan origination trends. With that, would you be able to provide some initial thoughts into 2025 and some of the opportunities that you see ahead?
Yeah, what I would say is, our overall outlook on scaling the balance sheet has remained unchanged, but given all the factors that I just mentioned with the appetite from credit buyers, as well as loss trends that we're seeing, gives us confidence in being able to continue to originate at a healthy level across all three of our products. I think breaking it down in each of the products, I think our home loans business provides us with ample opportunity. Right now, we're less than 0.1% of the overall market, but there's significant opportunity, particularly as rates start to come down. And we're now in market with a more robust product set. We now offer home loan refis, purchase, home equity lines of credit, and home equity loans. And there's ample opportunity, and I would originate as much as I could, just given the capital markets dynamic there, where there's an automatic takeout as long as we're underwriting to the specific formula. The other compelling fact in our home loans business is that less than 2% of all mortgages that are taken out by our Sofi members are taken out with Sofi. So there's ample opportunity even within our existing installed base where we wouldn't have to pay a second customer acquisition cost to scale this business with our members. On the student loan refinancing side and in-school loans, right now we're originating at less than half of where we were back in 2019 when we were originating on average about $1.7 billion per quarter, and we peaked out at $2.4 billion. I think as rates come down, there's ample opportunity there. We estimate the total addressable market right now is at about $280 billion in our credit box and where we can price these loans. So I expect that to be a good tailwind for us in 2025. And then on the personal loan front, like I said, record originations last quarter as a result of the significant expansion of our loan platform business where we're originating on behalf of others. We are happy with where the balance sheet size is for personal loans right now. But given the dynamic that we're seeing from credit buyers, I would expect to be able to continue to originate at a very healthy clip in 2025.
All right. Thank you, Chris. That's encouraging. Let's talk a little bit about Q4, kind of quarter to date and the recent updates. So the fiscal 2024 guidance was raised pretty much across the board: revenue, adjusted EBITDA, getting to GAAP profitability. Lending was a big driver of this increased outlook. Now it's expected to be at levels kind of more similar to 2023. Maybe talk a little bit about that lending strength, but also the increasing mix that you're expecting for financial services and technology platform in your revenue mix.
Yeah, what I would say is we're really happy with the momentum that we're seeing outside of our lending products in terms of revenue growth in Q3. Our technology platform and financial services segments comprised 49% of the overall total adjusted net revenue in the quarter. As a reminder, we had guided the street to having about 50% of revenue coming from those two segments and 50% coming from lending. So we're well on pace to do that. Where we're seeing really good momentum in financial services continues to be in net interest income that grew meaningfully as a result of growth that we had in deposits in Q3. We ended up adding over $2.4 billion of member deposits in the quarter. And we're also seeing really good momentum in non-interest income, which was up over 100% year over year, or over 200% year over year, driven primarily by our loan platform business as well as interchange growth. Interchange, we expect to continue to grow heading into 2025. We saw annualized spend levels in the $12 billion range in Q3, and that continues to grow quite meaningfully. What I would say is the overall growth looking forward in financial services is going to be a two-pronged approach, where we're going to continue to see really good momentum and growth in terms of number of new product adds each quarter. In Q3, we ended up adding growth of 40% year over year in new products. That's excluding crypto. And then the other prong is in terms of overall monetization. Right now in financial services, we're generating about $81 of annualized revenue per product, and we expect to continue to expand that monetization. So continued growth for years to come in terms of number of products as well as overall monetization. In tech platform, we're really opportunistic. We feel really good about where things stand with potential customers. We haven't lost any deals, and the pipeline is as robust as it's been in terms of the client selection process. So we feel good about the continued momentum both on the processing side as well as new deals that we're signing both in the bank side as well as other larger consumer brands. And then in lending, we talked about and already hit on, we expect continued momentum in originations across all three products.
Perfect, Chris. Thank you. And before we move into a little bit of a deeper dive on the three segments, you mentioned tech platforms. So let's just hit it. So one of your competitors, at least for Galileo, has mentioned a little bit of insourcing across some of their clients, and we talked about this on stage earlier with Marqeta. If you could just talk a little bit about what you're seeing in terms of either timing delays and/or insourcing, if this is a theme or anything that you're seeing in the business.
No, we haven't seen anything in terms of timing delays and no issues with our sponsor banks. As a reminder, Galileo is regulated via our holding company by the Federal Reserve. But to answer your question directly, we have not seen any issues.
Okay. All right. Thank you, Chris. All right. I said we'd go into a little bit of each of the segments. So we'll start with some comments on lending. So strong net interest income, strong NIM, deposits have grown. Maybe you could talk a little bit about the outlook there.
Yeah. So in terms of the overall outlook for our net interest margin, what I would say is we expect to maintain healthy NIM margins at north of 5%. That's obviously a function of a few things. First, it's a function of our overall loan pricing betas, where historically we've been successful in maintaining really healthy betas, even in declining rate environments where we've been able to maintain or even increase the weighted average coupon of the portfolio, which has helped keep really strong yields across our asset base. And then the other component is on our overall cost of funds, which continues to improve year over year. Sequentially, our overall cost of funds was down this past quarter, which helped us generate a net interest margin of north of 5.6%. Like I said, we expect to stay north of 5%. We still have opportunity to improve as it relates to cost of funds. We still have a little bit of warehouse debt that's outstanding, as well as some brokered CDs. And that will continue to drive the overall margins there. So net, we feel great about the net interest margins that we're delivering, but it's a function of our ability to maintain pricing on the loan side and continue to improve our cost of funds.
Okay, great. A follow-up related to that in terms of cost of funds. So funding mix. So deposits are now a large majority of the funding mix. Maybe you could just refresh the audience on what you consider to be the optimal funding mix.
Yeah, we've been really successful in growing a strong deposit base. We're at $23 billion of deposits today. Over 90% of those deposits are coming from direct deposit members. So super sticky, high quality deposits. Over 98% of them are fully insured by the FDIC. So we feel good about the progress that we've made in terms of growing that deposit base. I think right now we're at about 85-ish% of our loans being funded via deposits. Our longer term target funding mix is closer to 85 to 90%. So we're in a really good spot with respect to that and expect to be right around this 90% level going forward.
Okay, perfect. Thank you, Chris. All right, as the last one on the lending segment, let's talk a little bit just more of a, I mean, it's a SoFi question, but it's a broader industry question as well. But maybe update us on the general health of the U.S. consumer at this point in the cycle.
Yeah, so overall, health of consumer, particularly the SoFi consumer, is really strong. We're seeing it both in terms of spend behavior and financial services and our money product, where annualized spend levels are north of $12 billion as of the end of Q3, and that continues to progress here in Q4. In terms of on the lending side, credit is holding up in line with expectations, and we feel really good about that. We saw a bending of the curve from a delinquency perspective in Q1, a bending of the curve in Q2 in terms of overall losses, and we feel great about all of the efforts that we put into our maniacal focus on underwriting to the highest quality members and tightening credit over the course of the last 18 months. If you look at the cohort of loans that were originated between Q4 of 2022 and Q4 of 2023, they're performing meaningfully better than the last time we came close to our underwriting or risk tolerance of 8% life of loan losses, which occurred back in 2017. So we feel really good about the changes that we made starting in the second half of 2022, and that momentum continues into 2024.
All right, excellent. Let's move into the financial services segment. So we often talk about SoFi as being a one-stop shop for digital financial services, which means customers buying multiple offerings and products from SoFi. So broadly, before we get into some of the more detailed stuff, could you talk about the ARPU lift and some of the CAC benefits that you receive from this approach?
Yeah, what I would say is the overall monetization across financial services continues to improve. We're at $81 of average revenue or annualized revenue per product. That's up over 50% year over year. That's a function of a number of things. That's a function of the growth that we're continuing to see in products. It's a function of the deposit growth that we've seen, where our cost of funds is 200 basis points better than the next alternative source of funding. We're seeing really good momentum across all spend categories, and we've been able to expand our loan platform business quite dramatically. So that's what's been driving the overall uplift in ARPU in that segment, and we expect that to persist going forward. Right now, we've talked about this during our last earnings call, but we are under monetized in the invest business. We expect to be able to improve monetization. We recently rolled out new products with alts and mutual funds. We just made an announcement with BlackRock as it relates to our robo business, where we're now offering alts in addition to fixed income and single stocks in these robo accounts. We were a pioneer in IPOs and fractional shares. So you're going to continue to see us shipping new products, new features, new services, and innovating in the same way that we have over the course of the last several years, which will continue to improve overall ARPU. And then our credit card business is relatively small with just 300,000 accounts. You would expect us to continue to scale that business, which will provide additional uplift. In terms of the overall customer acquisition cost, we're acquiring members at the level that we're happy with and that we would need to in order to hit our longer term target margins of 30% EBITDA margins, and a return profile of 20 to 30% ROE. So we feel good about where that customer acquisition cost is. We have been more efficient over the course of the last several quarters and years in terms of driving sales and marketing as a percentage of revenue down. That's a function of a few things. It's a function of continued high levels of cross-buy. Right now, approximately 30 to 35% of all products that are taken out are coming from existing members on the platform, where we don't have to pay that second customer acquisition cost. In addition to that, we've made significant investments in brand, which just makes our direct product marketing dollars work that much more efficiently. And we're getting better and better at targeting our members. So those three factors combined are giving us the CACs that continue to improve and are at the level that enables us to hit our long-term target margins.
Okay, excellent. Thank you. Let's move on to, as part of the financial services segment, and you hit on this a little bit, but direct deposit. So direct deposit, the stats have been impressive. So more than 50% of newly funded accounts are setting up direct deposit within the first month. Can you talk about what's made SoFi so successful with direct deposit? And if there is, I'm not sure, but if there's an angle there that has a connection with the offering of longer duration loans.
Yeah, what I would say, it's a function of having a best in breed product, as well as our APY, which is a component of overall selection. So we've had a big focus on driving towards direct deposit members. It was a key priority for not just our money team, but all teams across SoFi when we got the bank charter and started focusing on gathering deposits. But it's a combination of having a best in breed product, as well as a focus on driving direct deposit as a KPI internally.
All right, excellent. Last one on financial services. So you also referenced this earlier, Chris. You talked about debit interchange. So we're about a year or so since you went over the 10 billion threshold for Durbin. So maybe you just talk about the interchange topic broadly, and then more specifically, the Fed's recent proposal to reduce the regulated interchange rate down lower than the current rate.
Yep. Overall, like I said, spend behavior really robust, north of $12 billion annualized. Interchange was up over 60% year over year in Q3. We've remained very confident in the overall spend behavior of our members, the health of the consumer. In terms of the overall regulatory component, I'm not going to speculate on what's going to happen from a regulatory perspective, but suffice it to say we're obviously monitoring, but remain very confident in the overall behavior that we're seeing from our consumers.
All right, great. Thank you, Chris. Let's go to the technology platform. So we're going to shift gears there. So we can talk a little bit about some of the expanded capabilities, right? So there's credit issuer processing. You've talked about some other things around BNPL, fraud prevention. There's the rewards capabilities. Let's just talk about what that means for Galileo in context of the broader competitive landscape.
Yeah, what I would say is, stepping back, Galileo was originally a pioneer in providing technology infrastructure for fintechs in order to enable them to innovate and offer better products at a more accelerated pace. We're now starting to see, as the product has evolved and the services has evolved, that it's starting to gain traction with larger, more established companies that will set us up to achieve more durable revenue streams, as well as larger companies that have large installed bases and financial services businesses. In terms of the specific differentiation for our tech platform, what I would say is it's the only full stack solution and the most robust product engine of any core or processor that's out there in the industry today. It's cloud-based, which makes it obviously developer-friendly, and it's evolved quite meaningfully over the course of the last several years since we acquired it. Second differentiator is we have a very experienced team who can serve as trusted advisors to our customers. And then finally, the other differentiator is that it's part of our holding company and regulated, so we're no stranger to regulation and understand all of those dynamics, and Galileo and Technisys are part of it.
All right, excellent. Let's talk a little bit about RFPs. So when you do those RFPs, if you could just talk about some of the competitors that you might run into, but specifically, Pismo was acquired by Visa, and that's one that comes up often in competitor discussions.
Yeah, we're not going to talk specifically about some of the peers or competitors that we see in these RFP processes, but suffice it to say, we obviously understood where the puck was going as a result of what we're seeing in the overall M&A landscape. Right now, our team is heads down in building the best product that can serve the broader marketplace. But no, I wouldn't comment on the specific competitive landscape.
Okay, let's talk a little bit about the TAM expansion opportunities then for the tech platform. So specifically over time, you've talked a little bit about traditional banks and maybe platforms, but let's just talk about some of the more TAM expansive opportunities that you see for this segment.
Yeah, in terms of the overall TAM, this is typically discussed in terms of payments because that's where the monetization lies today. But as you think about the longer term AWS of fintech concept, it speaks more to the business model and building out the architecture in the platform and the client facing components that will enable us to meet a number of different use cases across financial services and consumer brands alike.
All right, excellent. In the time we have remaining, let's see if we can fit in a few more here. The first one is around loan platform fees. So this past quarter, these fees contributed about 56 million or so to financial services revenue. Can you just talk a little bit about this business and how you think about it going forward?
Yeah, this is a great business for us. It's fee based, it's low risk and capital light. We were able to. This business has evolved quite dramatically since 2019 when we acquired Lantern Credit with the ambitions of creating a marketplace for all financial services products. It was a really good channel for personal loan declines for us. Over time, we're typically declining 70 to 80% of all personal loan applicants that come through the door. So there's a lot of potential members that we haven't been able to serve. And we also are trying to manage to a certain size of the personal loan balance sheet. On the flip side, from a capital markets perspective, given our desire to grow the balance sheet at the pace that we have over the course of the last several years, we haven't been relying as heavily on the capital markets because we wanted to grow the balance sheet such that we could generate meaningful and recurring net interest income on a perpetual basis. We have now found a way to unlock and meet the demand, excess demand that we're seeing both from a borrower perspective, consumer borrower perspective, as well as a capital markets credit buyer perspective. And we're able to originate on behalf of others assets that are aligned with their investment strategies and duration objectives. So it's been a great expansion for us. I think it's going to be a key driver of growth. The demand from a capital markets perspective has never been as strong, and we're excited about this opportunity. Again, it's low risk, fee based, and capital light.
All right, that's a great overview of that business. Thank you, Chris. Let's move, if we can squeeze this one in, sales and marketing leverage. So the broader topic, but you've been seeing a lot of it. So sales and marketing as a percentage of revenue continues to decrease year over year. So maybe just talk about that opportunity and how investors should think about modeling that.
Yeah, what I would say is we've been able to see that efficiencies as a result of overall scale that's driving it, but most importantly, the three factors that I mentioned before. We're getting better at marketing in specific channels. We're getting more efficient with affiliates and other channels. We have invested heavily in brand over the course of the last several years, which makes all of our marketing dollars work that much more efficiently. And we're continuing to see really healthy cross-buy rates at north of 30% on an ongoing basis. So you could expect there to be natural tailwinds as it relates to all three of those factors going forward. A lot of our growth right now is coming from growth in financial services products where the cost to acquire a member is lower than it is with lending. So that will serve as a continued tailwind towards overall sales and marketing efficiencies. But like I said earlier, we're at the level of customer acquisition costs that we're happy with, and it enables us to get to our longer term target margins. So I wouldn't expect to see meaningful improvements in overall CAC, because we're willing to pay a slightly higher CAC to improve the overall lifetime value of a given member.
All right, great. I think we have time to squeeze in one last one, which is related to a topic that you mentioned at Q3 earnings, which was around small business as a potential growth area. Maybe you could talk a little bit about that opportunity, maybe how big it is today. That type of context would be helpful.
Yeah. So right now our SMB business is very small and immaterial from an overall revenue perspective, but it serves as a real potential growth driver for our business. Right now, we are not principal in terms of doing small and medium business loans or checking and savings accounts. It's more of a referral partnership that we have in a marketplace where if someone comes in and they take out a loan or a checking and savings product, we would get paid a referral fee. But quite frankly, we have not invested meaningfully in terms of overall marketing in that space. So you would expect us to put more effort in towards investing in that product. It's a very high margin, great business for us, as is our insurance product, which we're also not principal, but in a referral business, and that will also serve as a big growth driver for us going forward.
Excellent. Well, on behalf of everyone at UBS, again, I want to thank Chris, Amanda, Paulina. Thank you for being here today and making the trip out to Arizona. Thanks a lot.
Thanks for having us, Tim.
Okay, so that was the entire segment, about 20 or so minutes there. I took lots of notes, so let's cover them all in depth to do a breakdown. There was a couple of main pieces here that I wanted to chat about. Of course, yeah, I also feel like he got defensive about the tech platform, but at the same time, like they're asked about the tech platform nonstop and whether they have, any logos to share or whether they have any commentary, and they never do. And I mean, we've talked about why this is the reason or why this is the case. So they sort of broke down everything sequentially from lending to financial services to Galileo, and a couple of interesting nuggets there. First of all, just overall thoughts that I had is it seems as though the sentiment that I was picking up is that they're focusing quite a bit more on monetization now, where they realize they have this large pool of members, and 30 to 35%, I think was the number, is essentially cross-selling. So he said there's higher levels of cross-buying here. 30 to 35% of all products are coming from existing members on the platform where we don't have to pay that second customer acquisition cost. So basically, they're getting these new, customers on these products for free because they enter the ecosystem through one product and then they like that product and then they just, start another product, whether it's entering through SoFi Money and then getting a mortgage, or whether it's entering through Relay and then going to SoFi Invest, or whatever the combination may be. So that's one of the reasons why sales and marketing has gone down as a percentage of revenue. But now that they realize that they have this huge base of core users, they want to be able to monetize this more. He said $81 was the annualized revenue per product. That's up over 50% year over year. And they basically are looking at it through two concurrent drivers. Number one, we want to increase the size of the pie. So we want to get even more members onto the platform in general. And number two, we want to increase the market share or the share of wallets that they collect, to say we want customers to spend more with SoFi than they have in the past. And they can do that through cross-selling into other categories, through new product introductions, deposit growth, so on and so forth. So that was quite interesting on the monetization piece that I found. I also thought it was interesting how, he was talking about rates falling and how that was going to be benefiting the home loans market. Less than 0.1% of the home loans market is what they currently have captured, and they have a huge runway for expansion in that category specifically. This is like the lowest individual segment in SoFi's loan or lending side of their business. So as rates come down, and in addition to rates coming down, as SoFi has introduced new product offerings, so home loan refinancing, HELOCs, home equity loans, so on and so forth, they're going to be able to expand that home loan market specifically. So, and again, here he was talking again about the cross selling because he was saying, hey, we have a percentage here of mortgages that are also taken out with SoFi. So they have the cross selling opportunities there as well. Personal loans, it seems that that's going, as planned. They didn't really increase any guidance or change any of the forecasts. They said, hey, we're happy with the balance sheet size with personal loans. We expect to originate at a healthy clip in 2025. Quarter to date for Q4, nothing really monumental here. He basically said, hey, we're happy with the momentum that we're having. And we have good net interest income from the deposits, 2.4 billion in the quarter in Q3. Non-interest income doubled in Q3. And he basically said here, interchange, which is non-interest income, is expected to grow in 2025. So financial services, I think, is, still doing quite well. The personal loan side of the business is doing quite well. Tech platform, I mean, this was the area where I think we got the least amount of details. He said we feel really good where things stand with customers. We haven't really lost any deals. I think that was, one of the big nuggets is we haven't lost any deals. The pipeline is as robust as it's ever been. There's no issues with timing on Galileo. There's no issues with sponsor banks. And then if I scroll down here, when he was asked further, he said, hey, we're starting to gain more traction with, and get this, guys, because he can't say it's Citibank or he can't say it's JP Morgan or whoever. He has to say, we're starting to gain traction with, quote, larger, more established companies that have large installed bases in financial services businesses. Like, that's like a textbook definition of, one of these large traditional financial institutions. And so essentially by them changing up their strategy to pursue larger deals that have larger or longer lead times, longer sales processes, it's going to take longer for you to find the accounts. But when you do eventually land those customers, they're more sticky because they're more reluctant. They have a higher switching cost. They're more reluctant to leave, number one. And number two, the amount of accounts that go up is much higher. So it has a bigger impact overall. He also talked about the differentiators for Galileo, saying, hey, it's the only full stack solution out there that has a robust product engine of any core in the industry today. And it's evolved quite a bit from when they acquired it. I also found it interesting that he talked about the regulatory aspect because they're held by SoFi. So they have all those regulations in mind. Loan platform business. This is really, I think, what's going to be an interesting piece for SoFi that's developing more and more. 56 million in financial services revenue from the loan platform business. He said it's a great business for us because it's fee-based, it's low risk, it's capital light. They're currently declining 70 to 80% of applicants that are coming through the door. So the majority, 7 or 8 out of 10 people, are being declined by SoFi. And now they have a solution, right? Because they have all of this demand from a capital markets perspective where they don't really need to rely on capital markets because they have their own balance sheet that they're growing through deposits. But they also have all of this demand from a consumer perspective because they're declining 8 out of every 10 people. And they're only keeping like the cream of the crop because they're a very high-end consumer base. Now they found a way to marry both of these aspects from the consumer perspective and the capital markets perspective because they're able to originate loans on behalf of others. And so that is really going to be a key driver of growth because it's all fees that they're collecting. They don't have to use their own capital. They don't have to take on their own risk for delinquencies and whatnot, right? So the demand, he said, and this I think is a key point, the demand from capital markets has never been as strong. What that tells me is it tells me expect more loan platform business deals to come in further quarters. Of course, we're going to get more in Q4 once they actually report earnings and they provide the full year 2025 guidance along with all of their projections. They're probably also going to revise the guidance that they have for 2026. If you remember at the beginning of this year in January, they provided that 2 or 3 year, I think it was 2 year guidance number where they said, hey, 55 cents to 80 cents EPS by 2026 if nothing changes. I guarantee you that if January comes around, they're going to not only provide the full year guidance for this year, but they're also going to probably revise that number for 2027 to account for all of these new changes. An interesting piece here that I think was a little nugget if you were listening closely and just paying attention. When he was asked about SMBs, small business loans, he said, hey, look, we're not a principal here. We're referral based. We haven't really invested meaningfully in the marketing for that space. And it's the same thing for insurance. We're a referral based on insurance. We refer you out to others and we collect a fee for doing so. We're not originating them ourselves. However, both of these will serve as a big growth driver going forward. So expecting more on the SMB front, expecting more on the insurance front for Sofi to bring it all in-house, to vertically integrate and consolidate those offerings into one cohesive, like one-stop shop, essentially, that they want to do. So those are some of the main pieces that I saw here. Of course, I'm going to be doing a video recap for all of these. So that's probably going to be up on my channel a little bit later today. But all very good stuff. I mean, nothing ground breaking, nothing earth shattering. But I found it interesting that they haven't lost any Galileo deal. I found it interesting that, he said there's amazing demand for loan platform business, and also that they're pushing for monetization, and also that they're pushing for insurance and SMB to eventually be a principal. And I think we're going to get more expansion, more details around those topics come January, when eventually Q4 is reported and when the guidance is provided. But those are the nuggets, that I picked up where, I thought, oh, that's interesting that he's mentioning that right now, or how he's talking about that, or even how he's phrasing that. Because in many cases, just the way that they phrase certain things is the hint, essentially. So you have to be paying close attention. Now, really, one other thing that I've talked about that I haven't mentioned yet is the operational efficiency of this business, the operating leverage. What I mean by that is, the revenue from these individual segments is increasing at a much faster clip than the expenses are increasing for the individual segments. In other words, they're essentially growing the profitability of these segments specifically. How are they doing that? They're doing that through efficiency in how they operate. And he mentioned a little bit of this here when he was asked around the customer acquisition cost. He said basically, hey, look, we have customer acquisition costs that we're happy with, and it's needed for us to hit that 30% EBITDA margin, which is what they're tracking for. He even said that they're under monetized in the invest business. He mentioned that multiple times, right? So it seems as though now that they've rolled out these new products, right? The alts, the mutual fund, the robo business, essentially, that they announced a couple of weeks ago, they want to up the monetization. And by doing that, they can up the operating efficiency, because as a percentage of total revenue, sales and marketing and others, where customer acquisition falls under, that falls as a percentage of that total pool. And as a result, each segment, especially financial services, becomes more profitable. But also, lending segment becomes more profitable because of that loan platform business. And so you can sort of see all of the pieces of the puzzle in real time here, how they fit together. The loan platform business is going to serve as a major catalyst for the lending segment. The operating efficiency with the new products that they're launching, and also the Sofi Money and whatnot increasing, the fact that they're under monetized in the financial services, that's going to serve as a catalyst for increasing this operating efficiency here. And don't forget, this segment of the business is growing like 80%. And then the third pillar is the tech platform, which we got the least amount of details about. And I honestly think that Derek White, or somebody from the Galileo team, David Foyer, maybe, I need to hear more from them. I'd love to hear more from them on a specific product level breakdown of what are we seeing, because I feel like for the financial services side of the business, we're seeing a lot of product level breakdowns, right? We had Anthony Noto in the last Fireside. He talked about Cash Coach. We had this new introduction with regard to the Robo Advisor. We've had quite a bit in terms of product level announcements in Fireside chats. What we haven't had is anybody talk about individual product level announcements for Galileo to the level of detail that is equivalent to financial services. And so I think having somebody like Derek White, who is a pretty interesting personality, I think he's pretty compelling in the way that he phrases things and in the way that he is talking about the vision for Galileo. I think having him there to be able to articulate that vision is going to do it's going to carry more weight than having the CFO do it. And I love Chris Lapointe and Anthony Noto, but they're not operationally day to day in the trenches the same way that David Foyer, the chief product officer, or Derek White, the CEO of Galileo, are. And I think we need to hear from those individuals as well, because the only thing that I thought was missing in this fireside chat specifically was more details around the tech platform, right? We had plenty of details around lending. We had plenty of details around financial services. I mean, we talked about all the way down to cost breakdown, operating efficiency, expenses, customer acquisition costs. We talked about the loan platform business. We talked about pretty much we talked about the mortgages. We talked about the funding mix, 23 billion in deposits, over 90% coming from direct deposit members. 98% of those are fully insured by the FDIC, which is a $2 million threshold. 85% of loans funded through deposits, and they expect to keep this mix. So we went super in depth in terms of the lending side of the business. We went super in depth in terms of the financial services side of the business. Again, nothing earth shattering, because we're not expecting him to drop, new company announcements at this forum. The piece that I think was missing, where we didn't go super in depth, was the tech platform. And so this is why I'm saying, I'd love to see people who are actually a part of that tech platform contribute more to this conversation, because I want to hear it from them specifically. I mean, one talk that we had, Derek White on the Banking Transformed podcast, I thought he gave a pretty clear bullish view on what he thinks is the future of banking and what he thinks Galileo's contribution is going to be to that future, and what he is doing to make that a reality. So that's all I'll say on that. But everything that we're seeing here says that everything is in line. I mean, SoFi is executing well. For a lot of people that might be, buying the stock at $15 or $16, they don't know a lot of these things because they just got in. But it's business as usual for these guys. I mean, I wasn't expecting anything massive. Just even the nuggets of information that they provided is positive. Okay, what did you guys think? Did he say anything about the cap call transaction? No, he did not. And I do not expect them to talk about the cap call transaction, because it doesn't really have any implications as of right now. It will have implications in the future, but nothing right now. So they're not going to talk about it. He wasn't even asked about it. And in fact, I thought that I know other firesides, there's been Q&A from the audience and whatnot, but I thought this fireside was really pointed, because as soon as they started, the announcer was like, hey, this is what we're going to talk about. We're going to talk about A, B, C, and D. Let me ask you specific questions. And it seemed as though it was semi-scripted, where they knew what they were going to talk about, and they knew the points that he wanted to make up front. So a lot of layups, I would say, from that perspective. Let's see here. Thatch says, leaps and shares are the plan. Anthony Noto will find a way to get to $45 in mid-2026. Yes, this is the performance stock units. He has to get to one of three tranches: $25 per share, $35 per share, or $45 per share by June of 2026. And that's what a lot of investors are basically expecting. That's what a lot of investors are betting on, in the form of leaps that expire in June of 2026. And, not only Anthony Noto, but Chris Lapointe as well, and many other members of the management team have similar performance units if they can hit those thresholds. And I think they have to maintain that stock price for about 30 days or 60 days. I think it's 30. But essentially, yeah, we need to be trading much higher than we are currently trading. The environment in 2025 and 2026 is primed for a company like SoFi to grow and gobble up market share. Yeah, man. Look, you're going into a lower rate environment, and you have this company that bought Wyndham Capital, and they're beefing up their home loan side of their business. It's their smallest segment in lending, and they have 0.1% of the market. Of course, that's going to be ramping up. Student loan, I think they said it was their strongest origination month since 2022. Personal loans, strongest since 2021, something like that. I'm just trying to find the actual quote here. But all of their business segments are going to be benefiting from this rate environment, from this macro, from this administration, and from the new products that they've launched, and especially the cross-selling that they're getting. And don't forget that cross-selling, the way that it works is it often dominoes, right? Because it's a lot through word of mouth and it's a lot through that personal experience. If you have more people, you have a wider base of total users. And so the cross-selling, if you have 35% of those users trying out new products, and imagine how quickly that can scale when you have 2 million or 3 million or 4 million users, it can be some really big numbers for this business. Let's see. Tevis, do you think SoFi is being secretive about the tech platform on purpose? No, I think that they really want to talk about the tech platform. I think it's two things. Number one, it's the fact that the growth rate for the tech platform is not as large as financial services, and the whole AWS and fintech. Like, you're not going to get there with a growth rate under 20%, to essentially make that the entire thesis of your company's differentiating factor. So that's one thing. I think that if tech platform had 50% or 60% growth rate, then they would be more inclined to talk about it and to spend more time to try to shift analysts' perspective to say, hey, we're actually a financial institution that's tech focused, whatever. But because the banking side of their business, the financial services side of their business are the fastest growing segments, then they're going to be talking about those more to analysts because, of course, you want to be talking about the revenue drivers, and analysts are going to ask about that. So that's reason number one. Reason number two is I think that their hands are tied in many ways with these large financial institutions, because SoFi's Galileo is essentially powering the back end of large financial institutions, and large financial institutions are competing with SoFi from the B2C side, right? If I am a consumer, I'm either going to bank with Citibank or I'm either going to bank with SoFi. And if you have Citibank that's now coming out and that's saying, hey, we're leveraging SoFi, then that's not a good look on them, right? And so a lot of these major financial institutions, the larger players, will not want to be advertising the fact that they're on Galileo, at least to start with. When SoFi is a more established player, 20 billion, 30 billion, $50 billion market cap, maybe it might be a little bit different. But, I just think that a lot of their hands are tied because of the partners that they work with. It's highly regulated, and it's highly hush hush from that perspective. So those are the two reasons. It's not fast enough growing for them to, have an outsized share of attention in these conferences or in these calls. And number two, it's because the target audience is, large regulated institutions. Once again, a boring fireside chat. Stock did nothing. Still buying and holding. Have about 4,000 shares. Yeah, I mean, the stock flipped. It's now slightly positive, but I agree. It didn't really do anything. I mean, I don't think we've ever had a fireside chat that I can think of in the last 3 years that have, pumped the stock like 10% or so. It's pretty standard stuff. There's nothing that I think that, he could have said there that would have pumped the stock that much. Maybe if he said, hey, we're working at Citibank or whatever, it would have, but they would have never feasibly done that. So he's trying to send that signal. If you read between the lines, and he's saying, hey, we're seeing stronger demand than ever from capital markets. And you're the one who's supposed to piece together, oh, wait a minute, that means loan platform business is going to do more than 56 million. Oh, that's going to actually trickle down straight to the bottom line because it's all fee based. It's going to be really bullish for SoFi. So he's not there to pump the stock. He's there to talk about the company, right? And it's also the chief financial officer. If it was the CEO, it would be a little bit different because he could talk about hey, what's the vision? Hey, what are the new products that we're launching? Stuff that's more exciting. But the chief financial officer is going to focus more on hey, what's the health of the consumer? What are the numbers? What are the metrics, the expenses, so on and so forth. Is a Delaware judge going to say those options? I don't know what this is. Probably the Tesla thing. I already expressed my thoughts enough on that last night. Let's see. It's hard to think of a better fintech stock to put money in than SoFi. As crypto wasn't going crazy, I think would be higher. Yeah, well, that's the other thing, right? I saw the new SEC pick, who's a pro crypto person. So there is chatter. I mean, mainly between us, the SoFi retail community, that a more favorable SEC pick towards crypto can be good for SoFi because it can decouple those regulatory requirements for chartered banks to not essentially, be involved in crypto. So we'll see. I mean, that's a possibility as well. Let's take a look. What's your EPS prediction for Q4? Yeah, I mean, I don't think it's going to be 4 cents for Q4. I think I had 5 cents or 6 cents EPS for Q4. I'd have to recheck my notes. But yeah, it's definitely not going to be 4 cents for Q4. It's going to be high, especially when you consider the loan platform business, right? And this is exactly what I'm saying around them providing revised guidance for 2026, because now they do have the loan platform business, right? Now they do have this macro rate environment that they were basically expecting at the beginning of 2024. And so they will have new product launches. Like if SMB, if they become a principal there, if they become a principal in insurance, they will be able and in a position to, over 2025, launch new products that contribute positively to EPS in 2026. Even if they land, several more businesses or several more deals through the loan platform business, that itself is going to put them outside of that expected range of EPS in 2026. He said, look, we've seen really good demand from capital markets, the best that we've seen over the last several years. We sold over 6 billion in loans in 2024, and that's not including the 1 billion in the loan platform business in Q3. So, just read between the lines. I do think that they're going to have a very positive future that's powered by these new initiatives, and they're consistently launching more, right? If you think about Cash Coach and what that could potentially provide, if you think about, home loan originations and how that's going to scale, or student loan and how that's going to scale over time, now that this whole mess with the Biden forgiveness thing is coming to an end, and now that rates are coming down. So, I think that's going to be very positive for SoFi as well. Let's take a look here. And people are talking about new. Let's take a look at new, where it's at. Yeah, 1170 right now for new. We'll see how it ends up. If it falls more, I definitely might start to get in. Any other questions on SoFi? Any other thoughts on the Fireside? I was trying to live tweet out some stuff, some quotes and stuff, as well as take notes. But I'll probably end up making a video a little bit later tonight around that specifically. I thought it was a good Fireside, honestly. I didn't, I think my expectations are a little bit different than you guys, because, if you're thinking it's going to pump or it didn't do anything, then that's an expectation issue. That's not really a Chris Lapointe issue. But, once you've been through a couple of these Firesides, you'll realize that, one, not much is said, and a lot of what is said is regurgitated from earnings. Two, a lot of it is just scripted remarks, basically, that they have the questions ahead of time. So you're not going to be in for any big surprise. And three, they usually are 20 minutes, and then that's really it. So you set your expectations accordingly. Okay, I think I will wrap it there. I've been live for over an hour. Thank you, everybody, for watching. Please do me a favor, if you haven't already, click that like button, click that subscribe button, and that way you can get notified when I post the video later today around SoFi and the CFO Chris Lapointe's UBS Fireside chat, and all the things that he talked about. I'm going to be cleaning up these notes, and I'm also going to be talking about some other recent SoFi news we've had. Thanks again for watching, and I will see. Hims Weekly is not going to be tonight. It's going to be tomorrow. So tune into the channel tomorrow to watch that if you're a Hims investor. Tevis, I will if you buy some Palantir. Sorry, buddy, not going to happen. I will just have to suffer without the like. Thanks all again. See you next time.